A positive 2025 would mark 3 consecutive positive years following 2022's correction, and catalysts such as the Fed easing cycle and expectations for deregulation under the Trump administration seemingly pushing them in that direction. Well, joining me this morning to weigh in is Ghabour, co-founder and CEO of Key Advisors Wealth Management. Eddie, good morning. Thank you so much for joining me. So those S&P 500 price targets around 6,600 are coming from analysts, including Goldman Sachs, Morgan Stanley, as well as UBS. So what do you make of those targets? And do you have the Dow and NASDAQ price targets as well as we head into year end?
So I think the path for next year is going to be very, very choppy, and it's really hard to try to predict where we're going to finish at the end of next year. I think we will be very, very strong in the equity markets. Finishing this year, I think we will get a Santa Claus rally. I do expect a little pullback here over the next 2 weeks. We're a little bit overbought. We've got some labor data coming out. We have some inflation data coming out, and a Fed meeting in the next 2 weeks that I think will give people that have missed out on this rally another opportunity to buy back into the market, get into the equities that are going to rally into year end and into the strong first quarter. So I think you should easily see a 5 to 10% move in equity markets from a broad-based perspective between now and the first quarter. Next year, I think we're going to have some air pockets because we still have a lot of challenges and some dark clouds ahead of us that I think we're going to have to risk manage through. So we have a big client event today. We've kind of telegraphed what we're going to be doing in the sense that we think that we will be de-risking sometime at the end of the first quarter, beginning of second quarter next year because of some of these air pockets. So you're going to have to be very, very active. But make no mistake, right now, it is a very bullish market, and I do think dips should be bought for those that have the right risk tolerance.
Yeah, and Eddie, building on what you just said, year to date, we're seeing the S&P 500 as well as that Dow Industrials up a double-digit percentage point. But when it comes to the Federal Reserve, the Fed easing cycle may not be as aggressive as the markets had initially hoped for heading into next year. So how much of a market catalyst will lower rates be for 2025? And what other catalysts are you also focusing on?
So some of the biggest catalysts, to your point, is the Fed. The market is still pricing in rate cuts for next year. And I don't think we're going to be able to have rate cuts because December more than likely will be the last rate cut in our opinion. And the markets won't like that. And the reason why we say that is one of the biggest catalysts that I think is going to drive the Fed having to pivot is inflation is starting to reaccelerate. And that is the Fed's worst nightmare, is a reacceleration of inflation. And we think we're seeing that happen and unfolding right now. And I think it's going to get worse over the next few months. So that means the Fed is going to have to recalibrate their monetary policy and let the world know that they may not be able to cut rates anymore. And the initial reaction to that will not be good from an equity price standpoint. I think it'll provide opportunities, but this is why we think we will see a very bumpy ride and sometime in the first half where we may have a downdraft. The other thing too is the dollar continuing to get stronger is sucking liquidity out of the system. And so we have, again, some dark clouds that are forming that we're keeping a very close eye on. And inflation, dollar, and I think the 10-year yield, because of all that, could go close to 5% and maybe above 5%. And those three things are our biggest concern for the first half of 2025.
Yeah, so those are things that we're keeping a close eye on, and you mentioned these concerns as well as risk factors, but can you also elaborate on some of the risks when it comes to inflation and the air pockets that you brought up earlier?
So when the Fed is cutting rates, when we are not in a recession, that is inflationary in itself. And I don't mean to be harsh on the Fed, but I disagree with them even cutting rates right now. I don't think the economy needs it. It has been very clear that this consumer has been very resilient. So when you're cutting rates, which is inflationary, in a non-recessionary environment, that fuels the inflationary numbers and calls it to accelerate at a much faster pace versus them just letting the markets take care of itself. And so I think that's going to be a big, big issue for 2025 because one thing that I think consensus believes is that the worst of inflation is behind us. And we are taking the other side of that. I think that we're going to have inflation not just prove to be sticky, but accelerate at a much faster pace than what the Fed thinks and what the market has priced in. And if we are right on that call, sometime in the second quarter next year is when we could see a pretty sizable downdraft in the equity markets. We're going to do our best to sidestep that and get out of our higher risk plays with hopes that we'll get a better buying opportunity later on in 2025. So that is something, again, that to us looks like it's happening right now, and it seems to be getting ignored by many investors.
And finally, Eddie, before I let you go, as we look ahead to 2025, there's a lot of focus on factors, right? Whether we're talking about growth or value, momentum, high dividend, or IPO, there are a lot of expectations, especially when it comes to M&A. So what are you most focused on right now?
So we have increased our exposure to small caps, consumer discretionary. We are still overweight technology and growth because in this type of environment where the economy is accelerating due to some of the things that the Fed are doing, we think these are the areas that are going to outperform over the next 3 to 5 months before we hit that air pocket. And so you want to be in those more growth-oriented names for those with the right risk tolerance. And that's been clear here since the post-election. You've seen things like healthcare and consumer staples and utilities and real estate really struggle. And you've seen small caps and growth and discretionary names really outperform on a relative basis. And I think that's going to be a consistent theme for the next few months.
Yeah, when you're looking at double-digit percentage gains across the board for all the factors, it is very helpful to dissect what's going on and look at what's happening under the hood. So, Eddie, thank you so much for joining me, and thank you for your perspective.
Thank you for having me.